Let's say you're a global investor in early 2025. For years, Africa has been on your watch list, but rarely in your portfolio. Too volatile. Too exposed to global shocks. Too dependent on commodities. So when the US dollar starts to weaken and global uncertainty rises, you expect African currencies to struggle like they always have. But then you check the data. Instead of collapsing, Africa's currencies are rallying. Some are up double digits. One is up more than 40% against the dollar. And suddenly, the question isn't why Africa is risky. It's why Africa is outperforming. To understand how this shift happened, we need to look at the forces reshaping Africa's currency markets and why investors are paying attention again.
Welcome to Spotlight in Africa, where we provide the clarity, data, and intelligence investors need to understand Africa's evolving markets.
For much of the past decade, African currencies lived under constant pressure. Rising global interest rates strengthened the US dollar. Capital flowed out of frontier and emerging markets. High inflation and trade deficits weakened exchange rates across the continent. Africa was seen as cyclical, booming when commodities rose, struggling when they fell. But beneath the surface, fundamentals were quietly improving. Central banks tightened monetary policy. Governments began repairing fiscal balances. External accounts stabilized. And when global conditions shifted, Africa was better prepared than many expected. The turning point came with a rare alignment of global and domestic forces. Over the past year, tighter monetary policy, improving trade balances, renewed investor interest in emerging markets, and a weaker US dollar created breathing room for African currencies. At the same time, a powerful commodity cycle took hold. Gold prices surged by more than 60%, driven by safe haven demand amid geopolitical uncertainty and shifting interest rate expectations. Copper prices climbed over 40%, fueled by accelerating demand from renewable energy, data centers, and power infrastructure, while global supply remained constrained. For commodity exporting African economies, export earnings surged. Foreign exchange reserves strengthened, and currency markets responded. No country captured this shift more clearly than Ghana. In 2025, the Ghanaian cedi gained nearly 41% against the US dollar, the strongest performance on the continent. This rebound followed a difficult period of debt restructuring and adjustment. Fiscal discipline tightened. The central bank maintained a firm policy stance. And rising gold prices dramatically boosted export earnings. Higher gold revenues strengthened foreign exchange reserves, improved government finances, and helped stabilize the currency. Inflation pressures eased. Import costs declined. For households and businesses, this meant lower fuel and food prices. For manufacturers and agribusinesses, cheaper imported equipment and raw materials. And across mining and related supply chains, job opportunities expanded. Currency strength translated into real economic relief. Stability did something else just as important. It restored investor confidence. With lower currency risk, Ghana became more attractive to foreign investors, particularly in mining, energy, and government bonds. Capital inflows increased, financing conditions improved, and the country regained access to international markets. This was no longer a crisis story. It was a recovery narrative, with momentum. Ghana wasn't alone. The Congolese franc rose by about 35%, supported by booming copper exports. Zambia's kwacha gained roughly 28%, as higher copper earnings strengthened external balances. In both countries, stronger export revenues improved dollar liquidity and eased pressure on local currencies, highlighting the leverage Africa holds in a world hungry for critical minerals. By late 2025, the picture was unmistakable. South Africa's rand advanced around 12%, benefiting from higher gold and platinum group metal prices, as well as gradual improvements in electricity supply and logistics. Alongside a weaker US dollar, These factors attracted portfolio inflows into Africa's most liquid market. The rand moved toward its strongest annual performance in roughly 16 years. Across the continent, Africa was being repriced, not as a macro liability, but as a differentiated opportunity. Not every country shared in the rally. Ethiopia's birr fell about 18%, weighed down by persistent foreign exchange shortages, elevated inflation, and the slow transmission of economic reforms into currency markets. The divergence underscored a key lesson for investors. Markets reward discipline, credibility, and execution. Looking ahead, elevated gold and copper prices, supported by global uncertainty, constrained supply, and growing demand from energy and technology sectors, are likely to continue supporting Africa's export earnings. But long-term currency stability will depend on what happens next. The real test is whether commodity-producing countries can use today's windfalls to strengthen other sectors of their economies, build diversified export bases, reduce vulnerability to future shocks. For investors, the message from Africa's currency markets is clear. Africa is no longer just reacting to global cycles. In key markets, it's starting to shape its own narrative. And those who notice early may find that the biggest risk is being late.
For more intelligence on Africa's economy, finance, and capital markets, subscribe to our channel at Spotlight in Africa.